Hey everybody, welcome to another special edition of um, Trading Far Out of the Money Options. This is part two of the installments. So in part one, I kind of talked about why I like the strategy, the benefits, the pros, the cons, things of that nature. So now I'm going to go into underlying selection, how I kind of like to set up the trade, um, things of that nature. So let's take a look at the slides. Let me share my screen. Okay, so a quick recap. So from last time, we talked about why sell far out of the money premium. Um, the high probability of success is one of the reasons I like to do it. Not having to watch the trade every minute of every day. Some of the automated systems for success that you can use, such as alerts and contingent orders. We talked about the realities of profitability, how much you could potentially make, what my returns have been, what people I know tend to make. We talked about potential losses, risk-reward ratio for these trades, which is definitely not good, but it's the trade-off that you have to make for the high probability of success. And then we talked a little bit about the optimal time frame for making these trades. The fallacy is that 30 days to expiration is just all the time, always the best option for selling. But with far out of the money options, that's actually the complete opposite. That is completely wrong. At 30 days expiration, as you can see, this is what the actual decay graph looks like, and at 30 days you will just be sitting on options that will not lose their value. The options model does not work well for far out of the money options, especially the closer to expiration that you get. It's going to say that you have theta in the trade and that you should be getting decay every day, but it's just not going to happen. So you want to trade somewhere around 50 to 70 days is what I find to be pretty optimal. 90 days is a bit far for me. It's a bit far out. I don't know many people that trade that far out. I know people that have trade as far as 80 days, but 90 seems a little on the high end. And again, if you don't believe me, trust an expert, qualified expert, author. He's written books on options trading, and he's a very successful trader himself, Jim Bittman. This is his quote, which reiterates my point that you want to trade far out of the money options, a little bit further out in expiration, not 30 days in. So that was the recap. Now let's talk about underlying selection. So a lot of people like to trade hot stocks. They like to trade Apple options. It sounds fun. It sounds interesting. And if you tell people at a cocktail party that you're trading options on Apple, everybody's going to want to know what you're doing. Saying that you trade the same index over and over again, and it's an index that a lot of people haven't heard of unless you trade options like the Russell, doesn't sound sexy and it doesn't sound fun, but it works. So this is, again, my opinion, but I prefer to trade the same index over and over and over and over again. Okay, so it's a marriage, but you know what? That's just the kind of person I am. I like to be familiar with what I'm trading, and I like to take a very methodical approach to my trades. I like to really learn the index, know how it's going to respond, and then also be able to look back at my previous trades so I can take a very methodical, detailed, and almost even a stats or a quant-based approach to the trade. So what I mean by that is that if you trade the same index over and over and over again, you're going to know what a great price is. You're going to know what prices you've gotten in the past. Based on the current volatility, am I getting a good price? Is $2 a good price? Should I be getting $2.10, $2.15? So you can sort of look back at your history of trades, and then you can really dig in deep and find out and make better judgments in the future based on the trades that you've made in the past. If you trade something new every single month, you're not going to know what a good price is. So you might go in there and say, okay, I want to trade the OEX or something like that this month. So you go in there and you look, but you don't know what a good price is for selling a 10 delta spread, 3 wide or something. So you go in there and you put the trade on, and bam, you get executed right away. And that's when you know you got a problem. If you get executed right away on the trade, you know that you probably got taken because you didn't get a good price. So, for me personally, again, I like to just trade the same indexes over and over again. I prefer the Russell. I like to trade the Russell. So that's my index. It's mostly because it's electronic. It's electronically traded, which is one great thing about it. It's large enough that I can trade a couple of contracts, and that locks up a fair amount of margin with low commissions. So that's kind of what I like to do. SPX is another popular one. I don't like to trade the SPX with these far out of the money trades because it's open outcry and you tend to get worse fills. So sometimes with the software, any software, the prices that are showed for the open outcry on the SPX aren't going to be as good. So you might not know exactly what the SPX, what those options are trading at based on what's going on in the pit, because it's open outcry and it's not electronically traded. So if I trade the SPX, I tend to trade the SPX with weekly trades, shorter duration weeklies, because the weeklies are traded electronically, where the monthlies are traded open outcry. So unless I'm trading at the money, I tend to not trade the SPX. I just don't want to trade it far out of the money. And as far as SPY is concerned, SPY is electronically traded, but the problem with the SPY is commissions add up really quick. If I trade 10 contracts on the SPY, I'm going to be paying a lot of money in commissions, whereas if I traded one contract on the SPX, it'd be a much better trade based on not only just complexity and execution, but commissions as well. So I'd like to quote somebody I like, Colin Cowherd. I listen to him a lot, ESPN Radio, a little plug for him. Check him out if you like him. He doesn't just talk about sports, he talks about life and sports. But he has a quote where he says, rich is fun, wealth is boring. And I tend to agree with him. So trading Apple, trading new indexes all the time, that's fun. It's interesting. It's always changing it up. It keeps you engaged. It keeps you interested. It gives you something to talk about with your friends. But trading the same thing over and over and again is boring, but works. So trust me, you want to learn the index that you're trading, and you want to know what you're doing and what your results were in the past, so you can make better decisions in the future. Other factors to consider around underlying selection are, is it electronically traded, which I mentioned again. It's going to give you tighter spreads. It's going to give you a better sense of where the market really is at. Liquidity. I know, excuse me, I had to take a drink of water. So I know a lot of times people will see some sort of maybe arbitrage situation, and in an underlying, they'll say, oh, look at these options, the volatility, this is a great price, you got to get in on this trade. And the first thing I do is, if it's a stock or an option that I haven't really heard of or I don't trade very often, is I look at liquidity, and I ask myself, if I put this trade on, even if I get filled, how am I going to get out of this trade? Is there enough liquidity to get out of this trade? And that's, again, another reason why I like to trade the Russells, that on those out of the money strikes, you have liquidity in them. So there's actually trades being made. Whereas in some of these smaller indexes or other vehicles, even stocks, especially when you get far out of the money, there's just not enough volume and not enough open interest in those far out of the money strikes to actually get filled if you needed to get out of this trade. You have to think about, okay, getting in the trade is one thing, but how do I get out of this trade? Is there going to be a chance to get out of the trade? And if the market starts to go against you and you get in a bad spot, if there's no liquidity, you are going to get screwed on your prices. You are just going to get completely just ripped on your prices, and they're going to take you to the cleaners. So you have to remember that and think about that when you're picking your underlying. And again, commissions, just think about that as well. Moving on. So, do we want to trade puts versus calls, or do we want to trade both in something more like a condor situation? So, traditionally, and I think it's always going to end up being this way, is that puts have more juice. This is because of the fear. We're always scared that the markets are going to go down, and people like to use puts for protection. So that way, for those reasons, puts have more juice. So when I made this presentation, I looked at the June 14 10 delta put, 51 days to expiration. I believe this was on the Russell, and it was trading at 580. And then I looked at the June 14 10 delta call, 51 days to expiration, which was trading at 260. So you can see right there that the put is worth far more and has far more volatility in it, so it's far more juice than the call. So it's much more lucrative to sell those puts than it is the calls. But on the flip side, you have more risk. And well, at least traditionally, you have more risk. People think in the puts than you do the calls. Now, over the last year and a half, you looking at some of these charts, you can say that the risk has definitely been on the upside, more so than the downside. But traditionally, you take the stairs up and the elevator down with the markets. So there's always going to be more juice on those puts. So calls can be traded, but the trend, the way the market's been, it's been kind of a bad bet to trade calls. Calls have been really a bad thing to trade over the last year and a half, because the market's just been trending up so heavily. Now, I used to trade two ways. I used to trade put spreads, and then I would also trade call spreads. But over the last probably 9 to 12 months, I've stopped trading call spreads nearly as much, because it just got too painful. I was constantly having to tinker with them, make adjustments, and do other things. Now, let's take a look at the chart really quick. So if we look at the Russell here, this is over the last like 6 months or so. But if we look at it for a much longer range, if we look at 2 years. So as you can see, over the last 2 years, it's been a pretty good, trend up. We've had a few minor dips, as you can see, but for the most part, it's been a steady trend up. So, selling calls, with the exception of a few short-term periods, has been probably not quite as profitable as selling puts, and especially anywhere, from, let's see, like, the beginning of 2013 to 2014. I mean, selling puts was definitely a good business to be in. I can vouch for that myself. I didn't have any losers that, all year selling puts. So that being said, if you look at where we're at now in 2014, especially the last few months, we could be entering a much different situation. So as you can see, since 2014, we're down a little bit. And if you look at the last few months alone, so let's look at the last 6 months, and then we'll look at the last 3 months. So the last 6 months, you can see we're going sideways. In a sideways market, selling calls is not bad. You might have had some pain here during this little march up, but in a sideways market, it's always good to sell. Selling calls can be profitable as well. But if you look at the last 3 months, we've had a little bit of a downtrend, in which case selling calls would be very profitable. Now, even in a slight downtrend or sideways market, selling puts can be very profitable as well if you have the right risk management in place. You can sell them in a slowly downtrending market. In any market that's sharply moving lower, you're going to have a lot of problems selling puts. But again, that's where risk management comes in place. So, as of right now, I haven't changed my strategy of selling just puts. I haven't jumped back in on the call side. I may here in the short term, because I've been looking more and more at selling puts, and I'm finding myself a little bit more nervous about about that the downside risk with the slight downtrend that we've been getting over the past few months here. So that's kind of my 2 cents on that. Let's go back to the presentation. So let's talk a little bit about units. Mark Sebastian, if you've ever read his blog or his book, or seen him, he calls them the secret to the pros. And let's talk a little bit about why. So there's a thing called fat tail distribution. I don't know if you've ever heard of it, but essentially says that black swan events occur more frequently than probabilities and models predict. So if you look at a lot of these trades that we set up with far out of the money options on your modeling software, whether you use Black-Scholes or whatever you use, the probability of profit is often very high. 90% plus, sometimes even as high as like 98, 99%. And you say, like, how is that possible? This trade can have 99% probability. If you just put it on all the time, then you should just always win, pretty much, right? But again, fat tail distribution says that these events occur more frequently than these models actually predict. So, how do we account for that? What do we do in order to protect ourselves? And that's where units or cheap, worthless, out-of-the-money options come in. Units have little to no Greeks, delta less than or equal to 3, and they're not really going to do much in terms of the model. When you add them into your trade, you won't really see much of a difference because, again, they have no Greeks. So they cost different amounts depending on the underlying. So, for example, a unit could be around 20 cents in the IWM or the SPY, but it could be closer to like $1 if you're talking on the Russell or the SPX. Now, the reason that these units are important, and the reason that Mark and other people who are expert traders tend to call them the secret of the pros, is because they have a hidden delta due to a volatility factor. So this hidden delta can really explode and add value to your position very quickly due to the alpha effect or a skew or shift in the skew curve. So when you've loaded up on a few of these options and you have a few of these units added to your position, which costs you, very, very little money, especially in the case of the IWM or the SPY, you're talking 20 cents an option. That's very cheap. So if you have a couple of these, and then we get an event like we did, on September 11th, or we get an event like the flash crash, or some catastrophic, complete plunge in the markets that's just way off the charts that nobody could anticipate, these things will help you out immensely. They will not only save your butt, but sometimes they can even turn your position into a massive winner, which would be completely unexpected. You'd never expect that from looking at the graphs initially, or the models when you initially put the trade on. So here is what we're talking about in terms of a skew, a shift in the skew curve. So we have our skew curve here, we have volatility and strike price. This is a very general example. That's why I don't have exact volatility numbers or strikes or anything listed here. But this is the typical volatility smile, they call it, where your puts are going to have a much higher volatility than your calls. So the way this works is this is your far out of the money puts way over here, and we move closer at the money, at the money, at the money, at the money. And once we get to the money, we have now our calls here. So this is the typical volatility smile that you'll see for most stocks and most indexes. Now, if we're talking futures or gold or other things, the volatility curve can look different. But for most stocks that you're going to trade, most indexes, this is what the volatility smile is going to look like. And when you have a catastrophic event, what happens is that the curve doesn't just sort of shift, doesn't just change a little bit in its trajectory. It actually shifts up completely. We can have a full shift in this curve up, where volatility just increases across the board, across all strikes. And when that happens, these units are going to explode in value. They're going to go from 20 cents to $2, and that can happen very rapidly. So Mark has a great blog post about this, where he talks about a position that he had with a butterfly. We had a few unit options added to the position, And during the flash crash, he actually ended up money despite the fact that he was far out of the web of the butterfly, or the net of the butterfly, excuse me. And you might say, how is that possible? And again, it's because these unit options really have a hidden value that you won't see in the model. So these are something that I like to add to my position as a sort of a insurance measure, just in case something crazy were to happen. So before we move to the next slide, just recap a little bit on this. So, I like to set up my far out of the money premium positions. I like to, make the sale, get the credit, and once I make that sale and I get the credit, then I'll go ahead and I'll add a few of these units to the position, maybe 10% or less I'll use for insurance, and I'll use that to add in a few of these units in case something catastrophic happens. Now, if you're trading very, very small, or if you have a very, very small account, then maybe it's not worth it for you to go ahead and put these units on, because worst case, if you lose $1,000, $2,000, $3,000, what's the difference? You're not going to be out in front of your house with your hat in your hand. But if you're trading much larger and you're trading, a position that's 10,000, 20,000, 30,000 in some cases, you might want to add in a few of these units to protect yourself, because losing a chunk of change that size can be much more damaging and detrimental to not only your trading psychology and your confidence, but your account balance as well. So that's where we'll end. Next time we'll pick up on what's a good skew to sell, and I'll talk a little bit about that. But for now, thanks for watching. I appreciate it. This is part 2 of trading far out of the money premium. My name is John Bloor, and I will see you next time.